Hi everyone. In this video, I'm going to walk you through one of the applications of the duration and convexity, which is reaching immunization of a portfolio against changes in interest rates, particularly if you have an obligation in the future. uh, then this becomes very important to ensure that the value of your assets, when you get to that point in time, when obligations are due, are enough to cover your liability. Now, in this case, we're covering a very simple case where we have a lump sum, a single liability 10 years from now, and yields may change. So we want to make sure, we want to invest, we want to form a portfolio such that we are immunized against changes in the interest rates. So now, a couple of the conditions for immunization, basic requirements. Okay, the first one is the present value of assets has to match the present value of those future liabilities, in this case, a single liability. The second is the duration of the assets has to match the duration of the liabilities. And finally, the convexity of the assets has to be greater, equal to the convexity of the liabilities. So we will first start working only with the duration, and then we're going to move on and consider the convexity as well. So let's work on the first step, which is present value of assets and present value of liabilities. We have to make sure that they're the same. Okay, so present value of our future obligation, we have a 6,000 liability 10 years from now. So the present value, we can simply get it using the PV command. I'm adding a negative sign just because PV returns negative values if all the inputs are positive. So we want that present value to be showing up as a positive number. So then this is the yield. This is the number of years until the maturity comes due. We don't have any payments. We have a single liability 10 years from now, which makes this particular problem quite straightforward. So we can ignore this. And then we can select 6,000 and the type is 0 and we're done. So the first condition we need is we have to invest our portfolio of assets, the value of that portfolio today. I mean, the portfolio of assets we are setting aside to meet these liabilities, it has to have a present value that matches this amount. Now, which or how do I form that portfolio? We will get there, but let's begin. Let us begin by evaluating three hypothetical cases. First, we invest only in bond one. Second, we only invest in bond two. Third, we only invest in bond three. So we have the different characteristics for each one of these bonds here, the coupon rate, the time to maturity, their face value, and their years until maturity, which comes from the time to maturity, the date of maturity, and the bond price. I have calculated these prices and even the duration from in these previous sheets. And I have covered in other previous videos, there's a very detailed calculation of the price of a bond, the duration of a bond, the modified duration convexity of a bond. So you can go over these previous videos and the calculations are essentially exactly what we are seeing here for each one of these bonds. But for now, I just use these outputs or values in our immunization problem. That's what we want to focus on now. So we have these prices which are coming from these sheets. And if you go over these videos, you're perfectly you would be able to get these values at the duration very easily. Now, the next step is we need the present value of our assets to be equal to the present value of those liabilities. So if I'm only investing in bond one, first hypothetical scenario, then I could do this by, well, if my liability, the total is this amount, 3,350. I just divide that. I go to the market and I buy 2.59 bonds. And that way, my portfolio of assets, 2.5944 bonds times the price of each bond, now I would have the same amount in bond one vis-a-vis the liability the present value of the liability. Hypothetical scenario two, I just buy this amount in bond two all completely. And then if I buy 3.35 on two, I would have exactly 3,350.37. Third scenario, I buy everything in bond three. So if I divide this present value of liability by the price of bond three, it would be 3.18 bonds, and 3.18 bonds would lead me to the same 3,350. This part, once again, we're going to work on that a little bit later. Once I now have this first condition, okay, so this is the portfolio of assets. Hypothetical, I could have three alternatives, either everything bond one, everything bond two, everything bond three. I have the quantity of each bond. So now I would have a portfolio of assets dedicated toward the repayment of this obligation 10 years from now. And the present value here matches the present value of the obligation. The present value of this hypothetical second alternative matches, and this one matches. So I now the next thing is to evaluate which of these three bonds would be a better investment if I am facing this liability in the future. Okay, and of course, the duration of those bonds are going to essentially just give us a hint in regarding which of the three is going to be a better fit if I have this obligation in the future. And then we will move on to, okay, what about forming a portfolio with three? Okay, so then let's move forward to the next step, which is let's assume that we move forward in time. Okay, so we are moving forward in time. Now it's 10 years later. So the maturity of each one of these bonds is going to be 10 years less the maturity that we had before. I can even add a row here saying updated maturity. Okay, so the updated maturity for bond one is going to be 15 minus 10. I'm going to lock this 10, and then of course let's convert this to not a percentage but a number. No decimals are needed. And then let's move this like this. So this is the updated maturity. If I buy bond one 10 years later, bond one will have a maturity, will have 5 years left. If I decide to buy bond two, then I wait. I move forward in time. 10 years later, bond two would still have 20 years to go, 20 years to maturity, and bond three would be essentially reaching maturity right there. Okay. So then the best way of evaluating what will happen with these, either this portfolio, or this portfolio moving forward in time, it's by calculating two different components. The first component is, well, my bond on its own will have an updated value, okay, which is likely going to be less because now it's going to be a bond of a shorter maturity. Okay, so I will calculate this, the updated price of my bond here. Now, the second is if I invested in each one of these bonds, I am getting their coupons, and when I am getting their coupons, I am reinvesting those coupons at the market yield, prevailing market yield, and therefore I would, if I am doing that, I'm doing this process of reinvesting coupons, which is what I'm supposed to do. Then I will have reinvestment. I will be able to have proceeds from these reinvestments, and we will calculate these too. So I will have a revised bond value and I will have reinvested coupons in a separate account. When I add the two, I'm going to have the actual total updated value of my assets 10 years later. 10 years later, let's evaluate bond one. So I will use again PV. And now let's assume the rate didn't change. It stayed at 6%. Now the number of years until maturity is 5, the updated maturity. Okay, and then this particular bond, the payment is $1,000 times 9%. And the face value I am going to get, it's $1,000. It's just that it's now, instead of 15 years, it's going to be 5 years from now. And type 0. We're assuming that if you forget, that's not a problem. It just assumes 0. Okay, so look at this. This bond one went, the price came down, and now the price is 1,126.37. So the price initially was 1,291, and it was trading at a premium because the coupon rate exceeded the yield. That premium, little by little, diminishes until at maturity, this updated bond price should converge to 1,000. So long story short, the updated price of our bond, which is now no longer 15 years away from maturity, it's only 5 years away from maturity, it's this. Okay, now let's repeat the same for bond 2 minus PV. We're assuming that the yields didn't change. And now the number of periods until maturity, it's 20. And I'm not sure if I already mentioned that, but for simplicity, we are assuming that these bonds pay annual coupons. So the calculations are simpler because in this video, we're not focusing so much on the price of the bond or duration calculations, but more on the immunization approach. So we just assume that bonds are paying annual coupons. Now, 20 years left. This bond too, it was originally a 30-year to maturity bond. Now it's only 20 years. The payment, the coupon payment of bond two, it is face value times that 6%, which by the way matches the yield. So this bond was already trading at par. The price was 1,000. The face value was also 1,000. Okay, so you will see there is something interesting here. And then comma, the face value is still, I mean, it's the expected value upon redemption of the bond is still 1,000. And then type here of the cash flows, we're expecting cash flows are happening at the end of each period. And there we go. So not surprisingly, here it's still 1,000. Okay, because the coupon payments match the yield. Whenever coupon rate matches yield, your bond will continue to trade at par. The price is going to be the same as the face value. What about bond 3? Bond 3 is a very special case because now we have reached maturity. So whenever a bond already reaches maturity, we will see what happens with the price. It's quite interesting. Then we are assuming that the rates did not change. They stayed at 6%. Now the number of periods until maturity is 0. No more periods. It's we are at essentially maturity. No, the payments, we will plug them anyway. It's a 1,000 times the coupon rate, which is 6.7%. But that will not matter much because the number of periods is 0. So that annuity is essentially not leading to any value in the Excel formula. And then ultimately Excel, we need the 1,000 face value and then type is 0. And there we go, is 1,000. Not surprisingly, a bond at origination will have a price that matches its face value because it's not going to, the bond would not be originated unless the coupon rate matches the yield. At expiration, upon maturity, the bond's price is also going to match its face value because at that point, the only cash flow left is the redemption value, and there's no more time to wait. So it becomes a 1,000 quote unquote dollar bill. And now during the life of the bond, the price and the face value are going to match as long as whenever the coupon rate is matching the yield, the market yield. Okay, now, so we have two components. We invested in these three bonds. We are evaluating how the price of the bonds evolved. What is the price of the bond I have in hand? But we are 10 years later in time, so during those 10 years, we received coupons and we deposited those coupons. So those coupons were generating returns as well. Okay, and we are assuming that these returns are also matching that 6% yield. So every coupon I got where it was deposited in an account and those coupons that were generating a 6% yield. So how much money will I have in that account? It will match the total amount of coupons I received and the interest I got from those coupons. So let's calculate that. Now, this becomes an annuity, and it's not that difficult. We just calculate FB, let's do -2. FB, now 6% is going to be the rate. How many? I'm going to have 10 periods. So Excel is going to read from what I'm plugging here. There are 10 payments of, and now let's specify the amount. And then those payments, because I'm getting the future value, are going to generate some return that is going to be 6%. Okay. Now, what is that payment? For bond one, the payment is 1,000 times 9%. So 10-year payments of $90. What is the PV? I'm not plugging anything here because this second leg of my calculation, I am only focusing on the coupons I received. I deposited them and I'm getting a 6% on that account. So it's like I started with nothing. My very first amount was the $90 coupon when I received it by the end of the first period. So I can either type 0 or I can ignore it. And I can type 0 here. I could also ignore it. Not a problem. And now that is the value of the reinvested coupons. Let's do the same for bond 2. So I would minus FB. The rate is 6%. Number of periods is 10. Then the payment of bond 2 is 1,000 times 6%. Comma, and then I'm ignoring present value and I'm typing 0 for the type. Okay, 790.85. And then now for bond 3, during the 10 years, I mean, we started in 2026 up here, and then we waited 10 years. Now it's 2036. So I also have some amount of money in that account. Rate is 6%. Number of periods is 10 years. And then the payments for bond 3 are 1,000 times 6.7%, $67. And then the PV, I'm focusing on the coupon, so I'm not adding, I'm not indicating anything there. And then 0. Perfect. Now, so 10 years later, I will own two legs. Uh, Irrespective if I invested here, bond 2 or bond 3, I will have two components. My assets are going to be dissected into two. Number one, I will have a bond, and now that bond, it's no longer 15 years, it's only 5 years to maturity. I can sell it, and my price is 1,126. And I will also have an account where I have been depositing the coupons that I received over these 10 years, and those coupons have been generating interest yield of 6%. That's a big assumption because I'm assuming my coupons are being reinvested at the 6% as well. So I have to reinvest my coupons in 6% instruments. The same thing for bond 2, the same thing for bond 3. When I add the two components, bond 1, I will have a total of 2,312. For bond 2, I'll have a total of 1,790. For bond 3, I'll have a total, when I consider these two components, of, not like this, of 1,883. Okay. Now, but recall, let's keep in mind that we didn't buy a single bond of each. This is per each bond. I bought some quantity. And I bought that quantity because I need it in order to reach immunization, the value of my assets to match the present value of liabilities. So then the quantity I bought was this, and this. So the total value of my portfolio is the value of each bond, the two components, the coupons deposited in that account and the updated price of my bond, okay, times the number of each one of the quantity of each one of these bonds I have. And not surprisingly, if rates have not changed, rates are 6%. The value of my portfolio is 6,000 for so I can invest in every bond. Now, that doesn't mean that I'm immunized. It only means that if the yields do not change, I invested in the present value of 3,350.37, which matched the present value of the $6,000 liability. When I get to the liability maturity, then my assets will also have a value of 6,000. Okay, so that is not surprising given that rates didn't change. Okay, but now what if rates do change? Okay, so then what I will do is let's re-evaluate these for these three bonds. And keep in mind, what we are assuming is I either invest here, either invest here, either invest here. So updated bond price for bond one. Okay, now it's going to be minus PV. Now my rate changed to 8.5%. Okay, and then what about the number of periods? Now the number of periods is 5 years to maturity. So I'm 10 years later down the road. What about the payments I have? This bond pays 1,000 times 9%. And what about future value is 1,000 and type is 0. So very good. So if rates do go up, look at compared to this scenario now here, it's a little bit, um, so I have a value that is a little bit lower. Now let's calculate bond 2 minus PV. My rate is now 8.5. The number of periods left is 20. No longer 30, but now 30. The payments from bond 2 are 1,000 times 6%, and the FB is 1,000, and future value is 0. Okay, and needless to say that these values are these values are lower because interest rates went up. So for example, here, the price of bond 2 was 1,000. It would have been 1,000. But in this scenario, because rates went up to 8.5 and this bond has 20 years to maturity, it's highly sensitive. So the price went down to 763.42. Now, what about bond 3 minus PV? And then I have the updated rate, and then I have the number of years left, which is nothing. So this particular case is quite interesting because we are essentially not this leg, the price of the bond is actually going to be one price at par. Okay, the payments are 1,000 times the 6.7%, but that doesn't make any difference because there are no more coupon payments left. We have already reached maturity for this bond, and then the face value is 1,000. Okay, and then type is 0. So then, not surprisingly, this is 1,000. So then we move on to the calculation of the reinvested coupons now in this case. So now this is an interesting part of the problem because we're having an assumption here. The yields changed to 8.5%, we are assuming, right? Uh, but then at this point, we're going to assume that the yields have changed right after we bought the bonds. Okay, so right after we bought those bonds, then yields changed to 8.5. The price of our bonds went down, but now the reinvested coupons are essentially going to give us a little boost. You could relax this assumption somewhat to some extent by assuming that, well, this yield is changing to 8.5 after the 10 years, or we are assuming now, we are assuming that this is happening at the very beginning. So at the right after we purchased the bonds. So just to be okay, so and this is an important remark because it's going to determine how we handle the coupons. If this change happened right after we purchased the bonds, then these coupons are going to be reinvested at this higher rate, which is going to be beneficial because we are losing. There is a negative impact. Price is going down because interest rates went up, but now we are getting slightly higher income from what we are getting when we reinvest our coupons. Okay. So then let's get minus FP. Now the rate is going to be 8.5% over a window of 10 years. Let's select it from here. And then the payment for bond one, the coupon payment for bond one is 1,000 times 9%. Okay, and that's the payment. We are ignoring PV and we are ignoring type, and that's it. Let me see. I can just lock this one here. I can lock this one here. Okay, and then I can just copy paste. But keep the here, keep the values. No, let's do it. FP. Okay, and then the rate is 8.5%. Okay, great. 10 years later, then the payment, if we look at bond two, it's 1,000 times 6%. And then we are ignoring PV, we're ignoring type, and there we go. And then the coupons, perfect. Minus FB, the rate now is 8.5, the number of periods is 10, and then the coupons that we received that were reinvested at the 8.5% were 1,000 times 6.7%. PB I'm ignoring, type I'm ignoring, and then there we go. So what is the total value per bond? We're adding exactly the same thing we did before. I mean, keep in mind up here, we assume that these rates did not change. Here, the big change, the big distinction is we're assuming that the rates did change to 8.5 right after we purchased the bonds. So we evaluate the reinvested coupons as if we are reinvesting these coupons from the very first coupon at an 8.5% rate. And then this is the total value of each, but let's remember that we bought this quantity, this quantity, and this quantity because we had to match the present value of liability and the present value of our assets. And that's the first condition up here for immunization. Okay, and then now what we do is let's look at the value of each one. If I had only invested in bond one, I would be above my bond, the bond I own would be 6,109.54. I mean, keep in mind we have two components. We have a bond that is worth 1,019, and I have reinvested coupons 1,335, and I have that 2.59 times the number of bonds that I bought. Okay, that's the notional. Here it's 2.59 times. And now if I look at bond two, if I add the two components, the price of the bond went down with the yields substantially. And then the reinvested coupons are slightly higher because I'm getting a higher rate. That this is the total. I bought 3.35. So if I had invested only in bond two, I would have a shortfall here. So my obligation, the whole problem is my obligation is 6,000. The value of my assets 10 years later, my bond two got hit. The bond got hit negatively, so it's worth only 763. I have reinvested coupons and I have some interest on those coupons that is slightly higher. It helps, but it's not enough, and I am falling short. I don't have enough. I don't have the 6,000 to meet my liability. What about bond three? Then I do have more. Actually, I'm doing very I'm highly above the obligation of 6,000. I have 6,353.15. Okay. So now, up to this point, we are only evaluating how bond one, bond two, bond three would move with respect to my liability, what their value is going to be 10 years later. And we see that if interest rates do not change, they would exactly reach 6,000. So I can pay my liability. But if interest rates change, then I would be okay with bond one and three, but I would fall short with bond number two. Let's look at the duration of each one of those bonds quickly. The duration that we got here is 7.6655, and this one, bond one, is 9.53, and this one is 14.59. Okay, and the duration of my liability is 10 years. It's a single liability, a single obligation. So in this case, the maturity of 10 years, it's also the same as the duration is 10 years as well. It's one single cash flow. All of the weight of that liability is coming from that cash flow. Even if we weight it by the time, we end up with the same 6,000. So the second condition for immunization is, well, we want the duration of assets and liabilities to be the same. Bond one is quite close. So out of all bond one, two, and three, the bond that takes me closer to being immunized uh, in against interest rate changes, and it allows me to be closer to my liability 10 years later, is bond one, because it's almost meeting the second condition, that the duration of assets and liabilities are almost matched. But it's not a perfect match because this is 9.53 and my liability has a duration of 10. So it's still not perfect. Okay, but then this one, it has a long duration, much longer, is 14.5, and then we can clearly see the problem. Rates moved in an unfavorable way, so my assets are much more sensitive to interest rates, and it's 14.59, their duration, and for that I got hit significantly, and that positions my assets below my liabilities. Now, so what can I do? Okay, let's form a portfolio where I have a duration that is exactly 10 years. And if I do that, then I would be immunized. Okay, so now let's look at the duration of each bond. I'm going to take it from up here. Okay, here, and now I have the three durations, and here. And then I can do this in two ways. I can use solver in order to find a combination of these three bonds that leads to a portfolio where I have such that I have uh, a duration of 10 years. So in order to use solver, I can just start with these some random weights. These are this is an initial seed. So solver is going to change it. And then let's simply go to data, solver. And then what I will do is I want to set an objective. Oh, before we do that, let's define the duration here. Okay, now, one of the positive things about duration is that you can get the duration of a portfolio by simply getting the weighted average of the respective durations weighted by the weight, how much you invest in each one. And in simple words, the duration of a portfolio is simply some product of the respective durations and how much you invest in each one. Once you have this here, this is close, but not that close. We want it to be 10. So let's go to data solver, and then we essentially set the objective to this is my objective cell. My objective function is B64. I want solver to meet a goal regarding this particular cell. And the goal is I want that cell to be equal to 10. So set the objective to the value of 10 by changing the weights, by changing B63 colon D63, subject to a couple of constraints. Subject to the first constraint is that all of the weights have to be equal to 1. So this cell E63 is equal to 1. And I am going to choose make unconstrained variables non-negative, so I do not end up with negative weights, but that is up to you. Then I solve, and there is a solution. Now I have to just clarify that there may be multiple solutions, but I'm okay. I mean, I'm reaching the duration. I'm only looking at duration. In this case, I'm not looking at convexity. Okay, so then I have this portfolio which has a duration of 10. And now we can go, I'm using this template that is provided in the class modules, and so it's easy to follow, and you can also follow if you have this template, follow along. So now what we are going to do is let's create this portfolio which has the weights that we derived down here using Solver, right? Now I'm investing 25.49% in bond 1, 26.83% in bond 2, and 47.68% in bond 3. Let's evaluate what happens if I invest in that portfolio instead of in these particular bonds one at a time. So what will happen is that the price of my portfolio is simply some product of the respective prices, and I am looking now back, I'm going back in time. Okay, so some product of these weights, and then that's it. So this is the price initially when I open up my portfolio. Okay, so if I am investing in those weights, and now this portfolio is like a hypothetical bond. Okay, so it's a bond, let's call it bond immunize, right? Bond I. Okay, now that would be cool. Just bond I. That is my what I'm forming with when I'm forming this portfolio. Okay, and there we go. Now, what is the duration of this bond I? I don't even need, I mean, by construction, the duration is, I already have it here, 10. So now the duration is 10. Okay, how much should I buy from bond I, which is a portfolio of bond 1, 2, 3, using the weights that I determined down here, which are the weights that make the duration of bond I perfectly 10. Okay, and then I have to buy the present value of my liabilities divided by this initial price. I have to buy 3.048899. Okay, which means that after I buy that 3.04 times the price of each bond, I am buying 3,350.37. That is not surprising. I mean, I'm just buying the same amount I have in the present value of my liability. So I can meet the first condition for immunization that the two present values are equal. Now let's move forward in time and evaluate this portfolio, but assuming that rates didn't change. I do not need to do these calculations because portfolio bond I is not a real bond, it's a portfolio. So I cannot calculate the value of the coupons, the reinvestment coupons. I cannot calculate the value of updated value of the bond on its own. But what I do instead is I do some product, okay, of the value from each one of the three bonds and the weights I invested. Okay, and there we go. And then let's recall that I bought some quantity here. And so the value of my hypothetical bond I, my portfolio, is 6,000. That is not surprising because in this scenario, I am assuming that 10 years passed by, but the yields did not change. So now I keep moving forward, and now I evaluate the situation where rates do go up to 8.5%. So once again, what I do is, and I can just copy this formula here. Okay, but instead of using these values, I'm going to use these values, which are the result of the new yield. Okay, so it's 1,994.63. But let's keep in mind that I bought this quantity, and now let's multiply the two. Now, immunization, it is not perfect, but we are not falling short. Okay, and we are a little bit closer to the value of my liability vis-a-vis bond one, which was the one that was closest to the liability. Now, the interesting thing is if I maintain the duration of 10 years, then I am able to reach a portfolio or a value of assets that is going to essentially be allow me to meet the value of my obligations. Okay, so now let's look at this graph, which is now updated. I was waiting for this to happen. Now I see that it's updated. And this is a very interesting exercise. Now, what did I do? I just used this formula here. So let's do this again. I believe I can do that. And now what I did is I created a data table. So I take this cell, which is the cell of the value, total value after 10 years, after rates change to 8.5%, it's here. This is the final number. This is how much I get after 10 years. And I just reference this cell at the top. And then I'm going to look at, okay, what if instead of 8%, 8.5%, it had been 0, 1, 2, 3, up to 12. And then I can just do this data, what if analysis, and then data table. And I'm going to just log, I'm going to say that these values to the left correspond to, instead of 8.5%, this is what Excel is going to use. And then that is how I get that curve, nice curve, blue line. Now, what is the interesting part about this? So once we reach duration equals 10, now, and I invest, as long as I invest in that portfolio and the present value of the assets matches the present value of my liabilities. So I invest 3,350.37 in that portfolio and the duration is 10. Having those two conditions, and we're not even looking at convexity, but having only those two conditions, then irrespective of the rates, look at the blue line, the value of my assets are always above or equal to or very close to the value of my liabilities, which is 6,000 after 10 years pass. So the rates during those 10 years can go down to zero or they can go up to 12. And the value of my assets are going to be higher or equal to in all of these and in all of these scenarios that I evaluated using the data table are going to be above. So then it's essentially immunized. Now, one thing that is implied here is that the solution I got from solver, it's also a solution where the convexity is higher for the assets compared to the liabilities. Okay, and that is expected because the assets are paying coupons and the liability is just a single lump sum obligation 10 years from now. But so we are meeting essentially in those values that Solver gave us, we are meeting this third condition as well. Because we are meeting this third condition as well, we are not concerned 10 years later, irrespective, so we are immunized. Now, very quickly, because I'm going to keep essentially the numbers, we already have these numbers here. So I have just moved to the next sheet. Now in this sheet, let's also look at convexity. So let's not just do duration, but let's also look at convexity. Okay, and once again, we're going to keep these portfolio calculations until the end. And then let's focus on this particular problem. Okay, so now we have here essentially the calculate duration for each one of the bonds. And we have here the raw convexity from each one of the bonds. And these convexities are coming from these calculations here. Okay. And so I'm just plugging this data that I'm getting in bond 1, 2, 3, which they can be calculated from the value, the parameters, the features of each one. And we have those here. Okay, now we can, or we should find a portfolio which has a duration of 10, but we also want a portfolio which has a duration of 110. Now, the convexity of that liability, okay, and I'm missing a parenthesis here. That liability only has a single um, cash flow. It's a lump sum 10 years from now. So because it's a single sum 10 years from now, then the convexity, if you rerun this for that $6,000 liability, the convexity boils down to T times T plus 1. Okay, so the convexity of the liability is essentially 110. If you repeat the convexity calculation, but you run it on this pension obligation, you will find out soon that you only have one single cash flow at the end, year 10. And then the weights that we impose with the convexity are T times T plus 1. You can go back to the previous video and watch those. So if you calculate this, the convexity here would be 110. So if the convexity of my liability is 110, now we have the conditions for immunization are 3. We just ignored the third one. Now we are considering the third one. We also want the convexity of our assets to be equal or to be higher, ideally, to the convexity of our liabilities. Okay, so what we are going to do is first, let's look at a system of equations, and then we can also use solver. Okay, so what is a system of equations? What I'm trying to do is I'm trying to have the following equations, all of them holding at the same time. Weight 1 plus weight 2 plus weight 3 has to be equal to 1. So sum of the weights equal to 100%. The second condition I want is weight 1 times duration 1 plus weight 2 times duration 2 plus weight 3 times duration 3. It has to be equal to 10. I mean, that is the duration of a portfolio. And the goal here is that that duration has to be 10. Okay, so duration of the assets, of the portfolio of assets has to be equal to 10. Why? Because the duration of the liabilities is 10, so that then we're matching. And then, similar to the duration convexity, you can get the convexity of our portfolio by getting the weighted average. So it would be W1 times C1 plus W2 times C2 plus W3 times C3. We want that to be 110. Once again, in the interest of time, if you quickly rerun the convexity calculations for a single lump sum of 6,000 occurring 10 years later, you're going to realize that you can get the convexity with a simplified form times T plus 1, which in this case is 10 times 10 plus 1, it's 110. So we have three equations we want so then convexity of portfolio of assets has to be equal to 110. Later on, I'm going to use solver because if we can get that to be higher than 110, then it's ideal. Okay, and then now we can convert this system of three equations and we can describe the system using matrices. Okay, so now the first line of the matrices, we have three equations. The first row of each one of these is going to come from the first equation. So it's going to be 1, 1, 1, 1. Okay, and then it's going to be 1. Okay, now what am I expecting here? Here I will have weight 1 weight 2, weight 3. So when I multiply this matrix by this matrix, I want to reach this goal. This cell is the result of this first row times this first times the single column matrix. So it's going to be 1 times weight 1 plus 1 times weight 2 plus 1 times weight 3. And then the sum of those weights has to be equal to 1. Okay. And I mean, we can do this equal to like this, like center. So equal to, wait, not like this, but like this. Okay, and even the vertical, okay, like this and like this. This is equal. And then we're doing this here. This is times. We're multiplying. This is okay. Okay. Now the second one, okay, it's going to be the duration. Okay, so the second one, it's going to be 9.53, 14.59, 7.7, 6655. If we look at this one, second row, 9.53 times weight 1 plus 14.59 times weight 2 plus 7.66 times weight 3, we want that to be equal to 10. And finally, we have the convexity. So 126, 330, 76.4 times this one times weight 1, this one times weight 2, this one times weight 3 has to equal to 110, which is my goal. So I know the goal. I know the values that I should use here, the durations and the convexity. It's just that I don't know the weights that hold, that make this system of equations hold. Okay, now this is the x. So then this becomes a problem like A inverse uh, times the goal. It's giving us W. Okay. I mean that's the solution to get the weights, which is the matrix of the unknown variables. So let's get rid of these, and now we can instead use M mod of M inverse of this matrix, then the goal matrix, and then we get the solution here. Okay, and now this gives us 110 and 110. So these are the weights. Let's confirm. Let's check them quickly. So weight that I'm investing in each one of these bonds. In bond one, I'm investing 286%. In bond two, now the values that we have used and the goals that we have used are a little aggressive. So the weights that we're getting are a little aggressive, but okay, we can live with that for this illustration. We have the weights invested in each one of these bonds. Okay, now let's confirm that we are getting the goal values. We want a duration of 10, a convexity of 110. So sum product of my weights, comma, my durations. And I have 10. Now sum product of my weights and my convexity. I mean, we can also just run that matrix multiplication and we would get this, right? We could just do a mod, and this is a 3 by 3, this is a 3 by 1. Mod here, and then the weights, just to, and then we're essentially getting the goal. So just like a check, in case anybody was wondering. Okay, so now we have that these weights give me that value of a portfolio of assets which has a duration of 10. So now I have a combination of weights of the bonds that lead me to a portfolio with a duration of 10 and convexity of 110. Okay, so there we go. Now what we can do in this case is let's work with these weights and let's work on the portfolios in the same way we did Before in this exercise, we were only looking at the maturity at the duration, but now in this case, we're also considering the convexity, and so we are going to get an even, I mean, immunization is going to be even more precise. So what do we do? The exact same thing we did before. Let's go back to the very beginning, even before the 10 years passed by, and we're going to do some product here. So if I had invested, these are the prices, and then these are my weights. There we go. Then this is the price of my portfolio on day one. Okay. So once again, I have these prices and then I have these weights. How much? Now, what about the duration? I can sum product of these weights, comma, this duration. And there we go. My duration is 10. How much should I buy? Well, the first condition is I have to hold a portfolio of assets with a value that matches the present value of the liability. So we're just taking the present value of liabilities, we divide it by the value of these bonds. So I have to buy 1.90. So just to make sure everyone is following, if I buy 1.90 of this portfolio of bonds, I am buying 3,000. I would have a portfolio of bonds worth 3,350.37, which matches the present value of my liability. That's the first condition for immunization. And that is at the beginning, before time passes by, before rates change. Okay, now just for completeness, let's assume 10 years pass by but rates do not change. Okay, so in that case, I'm not calculating these things on which I can get for a bond, but I could not get it for a portfolio. But what I can do is if I invested in some weights in each one of these bonds, then I would have a proportion of each one of these bonds that are equal to the weight. So that in other words, that is some product of the value of the bonds, component one, times how much I invested in each one of these bonds. Done. And then, okay, now that's the total value. So that already includes the value or the price of the bonds by the weights and how much I am getting from their coupons and weighted by how much I invested based on this optimization. Okay, now, but I recall that I bought 1.90. So if I bought 1.90, I am having this 6,000. Now, let's keep in mind that that is not surprising, and that does not mean that we are immunizing anything at this point. At this point, we are assuming that the yields did not change. The yields are 6%, but this is sort of a check just to see that we are doing things correctly. Now we are evaluating a scenario where rates change to 8.5%. This is the most interesting one. Okay, so what I'm going to do is, again, I'm going to do some product of each one of these values, which have two components each, the price of the bond and the reinvested coupons of a bond, and then times the weights I invested. And let's recall that I bought 1.90 of that particular portfolio, and then the total value is 6,042. So here we only considered duration. It was 6,081. Here I considered both. It's 6,042. So I am even closer. I'm getting closer and closer to the value of my liability after 10 years pass by. I'm getting closer and closer to that. Okay, and then this is the graph that is updated. I did the exact same thing. I referenced E55, which is the value, the calculation here. That is the optimized portfolio from my matrix optimization solution, and which gives me the weights that make these three equations, the system of equation to hold, right? So I just referenced this at the top, and then I created a data table here. So Excel is repeating exactly this calculation from E55, but assuming that rates are instead of 8.5, 0, 1, 2, 3, 4, 5, and so on, so on. And then this is how the graph looks. So if rates change in a given way, if rates go up, actually, my portfolio of assets is always higher. If rates move down, the value of my assets are following very closely the $6,000 of my liabilities. And then I have a little region here. If rates go down substantially, then I could still end up with a small shortfall of $50. And that would happen if rates go down all the way to $55, if rates go down to zero, okay, which is a theoretical number, but really unlikely in practice. And yes, immunization does not imply that every single time you're going to your value of assets are always going to be above the value of liabilities, but we are getting very close to that point, as close as possible. Now I'm gonna run because we have all these numbers already here calculated for the portfolio, and the graph is dependent on that. They are coming from these weights. So I'm gonna move our copy, create a copy, and now let's use solver to give something a try. I have not tried it, but I'm gonna try it right now, which is the following. Now, the sum of these weights is 100. Okay, that we already knew. But then these are going to be placeholders. So let me just copy them. These are right now coming from the matrix optimization problem we solved. Now, in the matrix optimization problem, we are we have the third equation requires the convexity to be 110, which is the convexity of liabilities, and we get it. It's the duration, the convexity of our portfolio of three bonds is 110. Now let's just do a little experiment here and see how things change if I instead just maximize convexity. Okay, so then I'm gonna copy these values. I'm gonna paste the values only. And now these are initial seeds and I can run solver. Okay, so I will say that I want to maximize, and my objective function is going to change to convexity. Now I'm using solver, which is a different type of optimization because it's essentially we're using an optimizer, we're using iterations. And then Excel gives us the value that meets that maximization, that gives us the maximum value for a given objective function. So we're maximizing convexity. Okay. Now by changing the weights, so B64 to D64, which is okay. Let me just select them again just in case. Subject to the following constraints, we want the sum of these weights has to be equal to 1. Oh, sorry, not has to be equal to 1. Okay. I have that one twice. The sum, let's delete this one. Let's delete this one. Okay, so now we're gonna add a condition that this is the sum, has to be equal to 1. And now my other condition here, it's that my duration has to be equal to 10. Okay, there we go. And to start, I will not check the box that unconstrained variables have to be non-negative. So I will keep the negative ones just to see what happens. And then I'm running this. So once again, I'm choosing B66 as my objective function, convexity. I'm focusing now, the whole optimization problem revolves around convexity. And I'm asking Excel to maximize it. by changing the variable, the cells B64 to D64, those are the weights. Subject to the following constraints, and I added duration as a constraint. So B65 has to be 10, and E64, which is the sum of the weights, has to be equal to 1, which is 100%. And I'm not marking unconstrained variables have to be non-negative. I'm keeping it like that. And then I'm solving. Okay. And then I'm finding this solution. Okay. That of course, and that is quite interesting. Of course, this is a very peculiar value because then convexity is very high. And look at this graph now. The weights here are also really, they add up to 100, but they are. So let me add a couple of more things to my problem here. I'm going to go to solver again and let me add that convexity. Now let me add that unconstrained variables, we want them all positive. Okay, and now there is a solution here. I like this solution more because the weights are sort of a little bit more realistic. And now the weights are essentially, this is telling us that we should invest everything in this specific case in bond number two, but it's breaching the duration constraint. So let us just get rid of these weights and let's run this one last time. Okay, so optimization convexity is maximized by changing the weights. I need the value here. Percent, 25%, and 50%. Okay, then solver. I'm maximizing convexity by changing the weights. So that is right, B64 to D64. And the constraints are that B65 has to be 10. So that's the duration, and E64 has to be 1. Okay, perfect. And now this is a good run because then duration has met the condition that we imposed, which is duration has to be 10. So yes, this is okay. Convexity now, it maximizes it to 162. In this specification of solver, in this setup, I required um, the weights to be all positive. And the reason is that if I allowed negative weights, then the solution gave us some really perhaps not realistic weights. But in this case, we have a combination of 34% in bond 2 and 66% in bond 3. The weights are up to 1, and the convexity of this portfolio is 162, which is much higher than the 110 we had gotten before. Okay, and then we end up with this graph again. So that illustrates really nicely. We were having some regions in the previous run. Let me just keep these weights and just to illustrate this. This is a very good thing. So these are the solutions from solver. We paste it here. Okay, and then these are the solutions we get from the matrix optimization where convexity equals 110. When convexity equals 110, duration is 10, convexity is 110. When we look at our graph, this portfolio is actually quite good. It is leading us to a value of assets that is way above liabilities when rates go up. But when rates go down substantially, we get to a point where we may run short, specifically here. If rates go down to 5%, then we are $5 for almost $4.2, $4.3 below the $6,000 value of the liabilities. Okay. And if rates keep going down, it's not helping us. And we are ending with a higher shortfall. It's not too much, but it's there. It's a shortfall. We are not reaching the value. Now, let's keep in mind that the condition for immunization is that convexity of assets is higher than the convexity of liabilities. And moreover, the more convexity we can get, the better off we are. Because convexity helps us. In a previous video, I explained that it helps us when rates go down, we are better off, and when rates go up, we're not as worse as everyone else, or compared to lower convexity alternative portfolios. So this one, we have a convexity of 110, and we have some issues, potential issues. It's very close, it's very good, but we have some issues. But now if we use this optimization, which is we are getting these values here, then we can get convexity up to 162. The duration has to be matched. That's a condition we cannot skip. But convexity, we took it even higher to 162, and then look at our graph now. It means that if rates go down, our assets exceed liabilities. If rates go up, our assets exceed liabilities. And now we can, and I would have peace of mind saying that this portfolio, which is 34% in bond B and 66% in bond 3, and 34% in bond 2 and 66% in bond 3, that leads us to a scenario where we can say, yes, now our portfolio is immunized and we will have enough value to meet our obligations 10 years later. Interestingly, if when we match the duration, the weights that we were obtaining without even looking at the convexity were, okay, they're different. 25.5, 26.83, and 47.68. Okay, so now by adding convexity, this is leading to even superior values, even better values. Once we can also consider the convexity, and now it's moving us away from bond 1 and 34% bond 2 and 66% bond 3. Okay, so then I hope this helps. If you are taking one of my classes, you probably have this template. If not, it's not difficult to just replicate it and work and follow along. This is not a difficult template to create. But I would like to say thanks for your attention. Reach out if you have any doubts or questions, and let's keep in touch.